A Magnificent 7 stock crash would be one for the history books, as the impact on the broader market would be absolutely significant. So what are the chances of a Magnificent 7 stock market crash materializing in 2024? What's my outlook for this group of stocks? And what can we maybe infer from historical stock market crashes? This is what we are going to talk about in this video. And so without further ado, let's get started. Alright, so in this video we're going to talk about the Magnificent 7 stocks and their impact on the broader market's performance. We will discuss whether those stocks are maybe overvalued or not, what to expect in 2024, and whether a potential decline of this group of stocks may represent an opportunity for you as an individual investor. So here's the structure of today's video. I'll briefly talk about the performance of the Magnificent 7 and their importance for the broader stock market in 2023. I'll then have a look at some 2024 predictions for this group of stocks and discuss whether a crash of this group of stocks is likely or not. I will thirdly have a look at the Nifty 50 group of stocks and maybe what we can infer from this historical example for the Magnificent 7. And finally, let's discuss what to do with all of the data that I'm about to present. All right, so let's start with the Magnificent 7 in 2023. What you can see on screen right now is an excerpt from Investopedia, and here it says the S&P 500 index comprises 503 large cap publicly traded companies acting as a proxy to the health and performance of the US economy. And basically, I want to question that statement. Is the S&P a really good proxy for the health and strength of the US economy if you consider that only 7 stocks, the Magnificent 7, represent a significant portion within the S&P 500? I don't have any current data at hand, but I know that in late 2023, this group of stocks, these 7 stocks, so that's Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla, represented around 25% of the weight of the S&P 500 index. And as such, as just 7 stocks represent around a quarter of the weight of the entire S&P 500 index, the impact of this group of stocks on the index's performance is obviously, very significant. And we can see this if we take a look at the S&P 500's performance in 2023 and the corresponding performance of the Magnificent 7. As you can see, the S&P 500 was up 24.2% in 2023, while the Magnificent 7, they all performed much better. Which, if you flip it on its head, means that these 7 stocks were responsible for almost all of the gains the S&P 500 made in 2023. And the remaining stocks, so the remaining 493 stocks, they joined the party relatively later, towards the end of 2023, when the market became increasingly convinced that the Fed will soon pivot to an easier monetary policy. But their contribution to the S&P 500's performance was much less meaningful. In fact, if you look at the data, without the Magnificent 7, the S&P 500's 2023 performance would have only been around 12%. Now, to back up what I was just saying, I found this interesting chart here on Coifin. Basically, you can see on the x-axis the holdings weight within the S&P 500, and then the y-axis shows the annual performance of the different securities. And as you can see, the securities with the highest weightings, so the Magnificent 7, I marked them in purple, they have all performed spectacularly well. 6 out of the 7 stocks have delivered returns of more than 50%. Only Apple is basically below this threshold, but Apple still also contributed with an annual return of 48% to the S&P 500's performance. And just to wrap up this last part, what you can see on this slide here is the performance of the S&P 500 market cap weighted index relative to the performance of the equal weight S&P 500 index. So in the equal weight index, every single security carries the same weight. And obviously, as the Magnificent 7 performed so tremendously well, the market cap weighted index outperformed the equal weight index by a very wide margin, by as much as 14%. Alright, and what I said in the introduction of the video, just as much as the Magnificent 7 contributed positively to the performance of the S&P in 2023, if those stocks will hit a rough patch, they will obviously impact the S&P 500 negatively as well, and they could do so in 2024. So let's discuss my predictions for this group of stocks going into 2024. And before I share my take, I would love to know what you think. So let's do a quick poll. How do you think the Magnificent 7 will perform in 2024? I'll provide 4 options. Will they yield a negative return? Will they deliver returns between 0 and 10%? Will they generate returns between 10 and 20%? Or will they once again perform better than 20% annually? And then maybe a second interesting question to consider is, what do you think? Who of the Magnificent Seven will be the best performing stock in 2024? So in 2023, it was Nvidia and Meta. And which one will be the worst performing stock in 2024? All right, now let's focus on my forecast. Here's what I will say. 2023 was obviously a monster year for those companies. And I can only hope that people will have a little lower expectations going into 2024, because I think a year as well as 2023 for these 7 stocks is fairly unlikely. It's not completely off the table, but I think it's more likely that we are going to see a year in which this group of stocks performs a little worse. Not saying they're going to lose money, just saying a performance as in 2023 is unlikely. I've seen one analysis that looked basically at an equal weight index consisting of the Magnificent Seven, and I think this index delivered returns of around 100% in 2023. All right, and what I'm showing you on screen right now is basically a survey in which fund managers were asked what they think is the most crowded trade going into 2024. And as you can see, the answer that received the most votes was that being long the Magnificent Seven is the most crowded trade. What I'm showing you on screen now is the price to earnings multiple of the Magnificent Seven. I chose not to include Amazon because I think during some quarters Amazon wasn't even profitable, which basically made this chart even harder to read. So I just excluded Amazon. You can take a look at Amazon yourself. What you can see is that Tesla is trading at a PE multiple of 76. We've got Nvidia at a PE multiple of 64. And what I will say is, and you can see that on screen right now as well, I think Nvidia was at one point trading at a multiple of 200 times its earnings. And to be fair, Nvidia has so far justified a premium to a market multiple because Nvidia was growing at such a high clip. As you can see, the PE multiple has come down significantly. And if you take a look at the Nvidia stock chart, you can see that stock itself is not down that much, which basically really shows that Nvidia has grown into its very high valuation. Although to be fair, a valuation of 64 times earnings is still like a very, very high valuation. Well, and then you've got Microsoft, Meta, Apple, and Google that are a little cheaper. Like they are by no means cheap, at least not optically, but they trade at more reasonable valuations if you consider typical benchmarks or thresholds. What I will say is, as we are trying to predict the performance of these stocks in 2024, is that all of these stocks are expected to continue to grow. So I compared here the last 12-month PE multiple to the next 12-month multiple of this group of stocks. And as you can see that basically going forward on a next 12-month multiple basis, all of these stocks will be cheaper. And I don't know, just based on the next 12-month multiples we can see on screen right now alone, I would have a hard time predicting that a crash of the Magnificent Seven is at all likely, especially as these businesses are expected to perform relatively well on a fundamental basis in 2024. Okay, next chapter. Let's take a look at history. And we'll start by having a look at how in the past the largest companies in the S&P 500 have performed over the next decade. So what you can see in this particular chart here is the 10 largest companies at the start of each decade, starting in 1930. And I guess the one big takeaway from this chart is that very rarely the biggest companies in the world will be able to maintain that position over the next 1, 2, 3, or 4 decades. There are a few exceptions, of course. We've got Microsoft, which was the biggest company in early 2000 and is still the second largest company today. But there are also very many companies that simply disappeared. And just to back this up, I wanted to show you one quote from Jeff Bezos in one of his early Amazon shareholder letters. I think it was his 1997 shareholder letter. He was writing, "We established long-term relationships with many important strategic partners, including American Online, Yahoo, Excite, Netscape, GeoCities, AltaVista, At Home, and Prodigy." And I decided to include this quote because I think very few of these names are still known today. So it shows you how quickly businesses can actually become less relevant or even go extinct. And finally, this is a chart that I already included in one of my past videos. This one shows that the 10 largest companies at the beginning of each decade. In 4 out of 4 cases, so in 1980, 1990, 2000 and 2010, have actually underperformed the S&P 500 over the next 10 years. So the 10 largest stocks in 1980, they underperformed the S&P by 2% over the next 10 years. The 10 largest stocks of 1990, they underperformed the S&P by 18%. Then the 2000 cohort, they underperformed the S&P by 6%. And the 2010 cohort underperformed the S&P by 7%. All right, if we now look at the Nifty 50, I'll get to what they are, what this group of stocks was in just a second. Well, we might consider whether the Magnificent Seven have a lot of similarity with that historical cohort. And I decided to include this post by Threads user Mike Value INV. He wrote, "In the long run, they will probably fade away, similarly to the Nifty 50 era. Remember, the growth opportunities for these huge companies are limited, and there is always the danger of additional taxes or antitrust laws if you get too big." And I think he's raising a couple of valid points. But before we get into the discussion of what he was writing, let me just quickly tell you what the Magnificent Seven actually were. So if we just head to Wikipedia, there it states, in the United States, the term Nifty 50 was an informal designation for a group of roughly 50 large cap stocks on the New York Stock Exchange in the 1960s and 1970s that were widely regarded as solid buy and hold growth stocks or blue chip stocks. These 50 stocks are credited by historians with propelling the bull market of the early 1970s, while their subsequent crash and the underperformance through the 1980s are an example of what may occur following a period during which many investors ignore fundamental stock valuation metrics to instead make decisions on popular sentiment. Yeah, and I can see why many people are drawing parallels between the Magnificent Seven and the Nifty 50. The Nifty 50, well, they also performed very well as a group until they didn't. Some of the components have been totally forgotten today. Like, I guess no one has ever heard of Digital Equipment Corporation or Simplicity Pattern, while other businesses are still very dominant and known today, like McDonald's comes to mind, or Coca-Cola, American Express, or Walmart. And these stocks are obviously still doing very well, and they have also done very well over the long term as long-term stock investments. What I will show you on screen right now is the valuation multiple these stocks were trading at the market peak, and the annual return they have generated between 1972 and 1998. And what you can see is that many of these stocks were in fact optically expensive. Many stocks were trading at PE multiples north of 30, north of 40, and some even north of 50. And even though this group of stocks outperformed the S&P on an EPS growth rate basis between those years, they still underperformed the S&P in terms of the total return generated by the index or this group of stocks. And as you know, my channel is all about fundamental value investing, and I always try to caution you not to make investment decisions based on hype, based on emotional reason, based on the market sentiment, but instead always to value the securities you are investing in to make sure that you can buy them at an attractive valuation and with a significant margin of safety. So will the Magnificent Seven follow the pattern of the Nifty 50? Quite frankly, I don't think so, because I think the Magnificent Seven companies, well, at least some of these companies, I'm more critical when it comes to Tesla as a business, for example, and I'm a bit skeptical of if the valuation of Nvidia makes sense. But as a group, I think there's a lot of quality in this group of stocks. And I think the management teams of these companies, they are also willing to innovate. They are still growing at decently high rates, except for Apple maybe. And I think they are also well positioned to benefit from many of the major trends like artificial intelligence right now and also in the decade ahead. So I think the comparison to the Nifty 50 is maybe not too accurate. The Nifty 50 was a group of more stocks, 50 stocks in total, as the name suggests, and those companies were operating in all sorts of industries, while I would say the Magnificent Seven is a group of stocks that is much more tech heavy. So in a way, if you say you were to buy the Magnificent Seven as a basket today, you would definitely place a significant bet on the tech sector. All right, so what's my conclusion? I guess it's hard to say. I will say that I think forecasting the performance of an individual stock or of a group of stocks or an entire index over a 12-month period is practically impossible. It's probably best to say, well, I simply don't know. However, what I kind of discussed in this video is that I think there's a lot of quality in the Magnificent Seven group of stocks, The valuation is not cheap, but it's not like exuberantly high either. So I don't know. As I said, let me know in the comments down below what you expect maybe over the next decade from this group of stocks. What I should maybe say is that I do own Amazon, Google, and Meta, so I might be a little biased here too. And with that being said, I'll wrap it up here. Talk to you in one of my next videos.